Conventional loans can actually kill your real estate deal if you don't know what you're doing and you don't know what they are, and a lot of people actually make this mistake when they start out. A lot of people think that you can just put 20% down and then that's it, but there's actually a lot more to the story than meets the eye. Even if it is the most common mortgage that people get, whether you're buying real estate or not, it's not always the best option for you. Hi, I'm Skylar. I am a real estate investor in Louisville, Kentucky. I've bought, rehabbed, rented out, and refinanced for a couple of years now. I also work with the Louisville, Kentucky mentors in the local area, so I'm in a pretty niche group, and I'm here to share what I've learned with you. Today, we're looking at conventional loans and how you can level up your real estate game. When to use them and when not to use them, or when you can't use them. By the way, this is for entertainment purposes only. You should seek a professional. This is not financial advice. Point number one, most traditional financing or banks look at the current appraised value of a home before allowing you to use one of their loan products. And you don't always actually have to come in at 20%. You can actually come in with less by using what people call sweat equity. Sweat equity is great because you can actually put less than 20% down on the house, get the house, put the work into it, and then if you've put enough value into it, then you can actually raise the value of the home, which actually would raise your percentage ownership of the house. This is what this looks like in examples. So let's say I buy a house that's worth $200,000 and I put a down payment of 5%. Normally, if I left it there, then I would have to pay private mortgage insurance. But if I pay the 5% and then let's say I do the wall trimming and I paint it up and maybe I fix some of the carpeting or do some of the drywall myself or even pay a guy to fix the roof. But a lot of times you're actually going to make more equity on the property than the cost it took to fix up whatever needs to be done in the house. So now the house, after it's been fixed up, let's say it's worth $250,000, but you put 5% on $200,000. Now you easily owe at least 20% equity on the house. Point number two, and self-employed people, pay attention because this really applies to you. If you're self-employed or you own a business and you write off a lot of deductions, there's a possibility that this loan will not work for you at all. And why is that? Well, there's 2 points to that. Number one, the banks look at your debt to income ratio. So if you're like me, and you're writing off all of your expenses, well, you're going to lower your adjusted gross income on your tax returns. But if they look at your adjusted gross income versus your debt, well, now your income is a whole lot lower, but your debt remained the same. So your ratio is too high, could be too high. Reason number two, and it's kind of an obvious one, but your income is just too low. You wrote off so many expenses that you could even be on paper below the poverty line. Point number three, this type of loan typically offers, not always, but typically offers the best interest rate and terms for you because it's considered the safest option in terms of getting financing for your house. And as we all know, if the interest rate is lower, well then obviously your mortgage payment every month is going to be lower as well. That's great. However, it should be noted that if you do not have a FICO score of at least 720, you're probably not going to get the prime rate. It's probably going to be something under that, and then therefore you'd have to decide if getting a conventional loan is still worth it or not, or if you should go with another option that is no income verified. By the way, like the video, please subscribe if you would like to see more of this content. I have a million other financing options that I'd like to share with you that I can't obviously put into one video, and you liking the video helps me and helps yourself. Okay, last point. There is a hard ceiling on how many conventional loans you can have at one single time. The number is 10, and after that, you actually do have to think of other loan options. At that point, there's nothing you can do. You have to think of other options. So if you'd like to, I'm going to make another video. In the next video, I'm going to go ahead and cover dscr loans, which are no income verification loans. So when you do pass the 10 house threshold, you can start thinking of how do I buy more houses, but use maybe unconventional financing. And again, if you're serious about investing in real estate, please give me a follow, subscribe. We'll talk all about it. I am doing this series in order, so please follow, watch the entire process so you know how to buy a house from analyzing all the way to the finish line, which is you refinancing it or pulling equity out or fixing, flipping, long-term holds, whatever you're trying to do. Anyway, thanks so much. I'll see y'all later.